And the solution to add trust to the system and to heal the financial system, we need a higher gold price. It's as simple as that.
My guest today calls himself a gold analyst, but I think of him as a vigilante investigative journalist of the gold market. And in his latest piece for Money Metals Exchange, Nieuwenhuijs has uncovered 4 reasons why he believes the gold market will shine in 2025 and beyond. If you're a gold investor who's very happy with their gains so far, both recent and long term, but you're getting a little bit twitchy because things are too good to be true, I urge you to check out Jan's article from Money Metals Exchange, or just keep watching this video. Jan, thanks for coming on. Gold has a greater than 10% average return over the last 10 and 20 years. It absolutely soared in 2024 and adjusted into pounds, euros, yen, Aussie dollars, or most other currencies except the US dollar. It barely even had a break in that rally. So Jan, you must be getting worried about a correction here, or perhaps a range that we're stuck in for years to come.
No, I'm not really scared of a correction. I think gold will continue to march on because of the imbalance between credit and money. I'm going to use a few phrases in this interview. With credit, I mean financial instruments with counterparty risk, and money is gold. So gold has no counterparty risk because it's not man-made. And that's interesting because even Bitcoin is man-made, and although some people say there's no counterparty risk in Bitcoin, Bitcoin is still man-made, and I think most central banks still think, well, we're not going to buy Bitcoin because it can still be destroyed by whatever quantum computing or whatever. Some central banks now are. I just read the Czech central bank is planning to buy Bitcoin. So maybe some do, but still gold is not man-made. It has zero counterparty risk, and it has been the foundation of the financial system for many centuries, maybe even millennia. And so there has always been this balance and a movement between, and we've talked about this before, between a lot of an economic boom and a lot of credit being extended in an economy and a lot of growth, and everybody likes credit and asset prices going up and dividends and all that. But eventually you get a bubble, and then there is a correction. Now what usually happens then in the correction is that the gold price goes up, because how I look at the financial system is I take Exter's inverse pyramid, so that's right this shape. And at the bottom sits gold. It supports the rest of the financial system. Above gold are national currencies. Then come debt securities, then equity, and then derivatives. So if there's a boom, the crown of the pyramid widens, and the pyramid does this. And that's actually where we are now. If you look at historical charts, you can just see that the pyramid is like this. There's so much credit resting on top of a tiny foot of gold. And that's an imbalance. And, all those financial instruments, their value depends on trust. A sandwich you can eat, if we talk about goods and services, a car you can drive in, a house you can live in, that all has use value to us. But financial instruments, everything in the pyramid, that value depends on trust, and we trust the economy will grow, and that is why we invest in stocks, because we think companies can increase their profits in the future, and we accept money for the work we do because we trust we can spend it the next day at the bakery to buy bread. But it's a trust question. So, but this has the least trust is necessary for gold to function because it has no counterparty risk. So, but if you have a pyramid looking like this, there's a lot of confidence, maybe overconfidence in the system. And then if the bubbles pop, then of course there is more trust needed. And what then happens is that the crown does this, credit defaults and everything. But also other things happen, and that is that investors, they run down the pyramid, they run to gold. Hi there, it's my neighbor. They run to gold, so the value of gold increases. So the base of the pyramid also does this, and also because if governments would allow all the credit to collapse, there would be a deflationary debt spiral of collapse. Sorry, the credit is also debt, of course. So there's a lot of debt in the system now. We know that. If we would get deflation, of course, that's a problem for people having debt, are in debt. If your wages go down, then it's very hard to pay your mortgage. So governments will fight deflation, and so they don't really want the crown of the pyramid to do this. What they want then, the solution is that the gold price increases, so the base increases. There's more trust in the system, and then the shape of the pyramid is remodeled back into a neutral shape, and those are the debt cycles, right? So the debt cycles are this, 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 and so I think we're going to look at some charts now that illustrate what I just talked about this this visualization of the financial system, and we can see that the pyramid is now in a shape like this, and the solution to add trust to the system and to heal the financial system, we need a higher gold price. It's as simple as that. And but I can expand on all sorts of assets and details when we look at the charts.
Yeah, one of the things that I need to make clear here is that money, as the rest of us use the word, is part of this credit and debt system, because that's how money is created, so it's part of the debt system. So the base of the pyramid, the thing that the trust rests on, gold, is money, because that's the original form of money. National currencies were born out of the idea that they were backed by gold. We've got these 4 charts that we can go to. But all of those measure the things that you've just said. They're ways of measuring whether the pyramid's widening or narrowing, whether trust is growing in the financial system or trust is falling in the financial system. And the idea is that when trust starts to fall in the financial system, people turn to gold, as you say. They come down the pyramid. And that's why the gold price tends to rise when trust in the financial system is falling. And these 4 charts that you've put together suggest that we're on the beginning of such a phase. That although the gold prices have gone up a lot, the real message here is that trust in the financial system is starting to decline, or has been declining, or is about to decline. And that this is, historically speaking, been good for gold. So let's get to the first one. It's the monetary gold to money supply ratio. So before we show this chart, let's just make clear what those two are. So what's the monetary gold?
The monetary gold is the gold that the United States government, the Treasury, actually, it's not the Federal Reserve, but it doesn't really matter, owns, which is in a way, supporting, because gold is the asset of last resort. It's the backup plan. It's the bedrock for the financial system. So the U.S. monetary gold is the gold that the U.S. government owns. The broad money supply is, of course, the amount of dollars in circulation. It's M2. A lot of people know it. So if you look at the ratio between the two, you get a sense of, how much, how big the foot of the pyramid is versus the next layer, national currency. And you can just, we're going to look at the chart, and you can see this ratio going up and down throughout history. And every time it goes down a lot, so that means there's very little gold supporting the national currency. There's overconfidence in the system. Then there's a correction. The gold price goes up, and the ratio as well.
Yeah, so the ratio is in blue and the gold price is in gold, obviously. We'll ignore that light blue line because the chartist stuff we'll leave out for this video. The narrative here, tell me if I've got this wrong, is that trust in national currencies is declining. People no longer believe that central banks and governments can manage the money supply properly after this inflationary experience we've had. Therefore, more and more people are turning to gold, which is why the gold price is going up. Has that already played out? Is there a crucial level at which there's a signal here? What's going to happen next?
Well, I think, yeah, it's true what you said. People are losing trust in national currency, also because of inflation, also because of the public debt. And the fiscal deficit is just so large that there is no way out for, there are only a few options. If you have a debt this high, is austerity. Now, well, they're never going to do that. Increase taxes, well, that's not going to happen. Not under Trump, not under the Democrats. What else have we? We have default. They're not going to do that. So, the most common big way to solve this historically is inflation. So that is a loss in national currency. Sorry, I forgot exactly what your question was. I'm not sure if I.
Also, I'm trying to get at the cutoff level at which this ratio tends to turn, which obviously you can see from this chart. It's the 2.5%. Whenever this ratio has gone below 2.5%, meaning that the value of monetary gold relative to the currency is less than 2.5%. In other words, gold backing the currency, the value of gold backing the currency is below 2.5%. We get this turnaround.
Yeah, well, the 2.5% is just what I see in the chart, and then I make up that's the rule. But there is no written rule anywhere that, but looking at the chart, yeah, every time it dips below 2.5%, that just shows there's so much confidence in, national currency and credit and all that, that's usually the bottom. It can stay there for a while. In the 1990s, it was quite a while below 2.5%, and that was the great moderation. Of course, and but after that, we learned that the Great Moderation was not exactly all that well in terms of at the time economists and central bankers thought they had solved everything and there would never be a recession again, and but it was all based on debt and credit. So and that's coming back now as a boomerang, and we saw what happened in 2008, and we also see now what's happening with wars, that you get a lot of less trust in somebody else's currency. So, but that's for another chart about the foreign exchange part.
Well, hold on. Let's explain what's happening here in terms of really easy to understand. Imagine you've got a bank, and it issues currency that's backed by gold. What this chart's sort of showing is that the amount of gold that is backing the currency that's been issued is falling below 2.5%, right? So at some point you get what's like a bit like a bank run. You get people saying, well, if there's only 2.5% worth of gold backing all this currency, then at some point people are going to show up at the bank and say, we want the gold, not the currency, because we don't trust it anymore. And that implies that the value of that gold surges, right?
At this moment, we're not on a gold standard, so you can't. It's not that people think, oh, there's too little gold at the bank. But what happens is that too much credit creation just blows bubbles, and at the end, when the bubble pops, they flock to gold again. And so it's I always say that the financial system is not backed by gold, but it's still supported by gold. I think 99% of the central banks on Earth still have gold in their vault and not something else. And that is really that is the backup plan. There's nothing else. It's gold. So that is all. And then from the gold and the national currencies, it's backing all the rest.
So it's not just people questioning their own currencies and their own governments. It's also questioning each other as well. And this chart, possibly one of the drivers of it, is what happened in 2022 with Russian reserves being frozen. So take us through what happened there and how it might be impacting this chart.
Yeah, of course. Well, yeah, as we all know, gold investors, in 2022, Russia invaded the Ukraine, and the West decided to freeze Russia's foreign exchange reserves, or the part that they could freeze, euros and dollars. And what that was just a shock throughout the world, and mainly in China, but also other central banks became. This is predominantly a PBOC story, but central banks around the world started to buy a lot of gold. So that drove up the price of gold, and also made the value of the U.S. monetary gold worth more. So that also changed the ratio we see in this chart. And of course, also we see the gold price going up now. And that is just the beginning. if you see the blue line going up a little bit, that is just the beginning of the correction between the two, between dollars and the US monetary gold. And this is just, we're just looking at one country now, but the US is the largest economy in the world, and it's also the world reserve currency, so it's very important. It does make sense to look at this from an US perspective.
Yeah, the US dollar is sort of the little sliver above gold in the Exter's pyramid, which one step more important than other national currencies. Let's move on to the second chart here. It's another ratio, just to make things confusing. It's the stocks, so companies' shares to money ratio. I think your money ratio is the same again. It's M2. Take us through what you mean by stocks.
So that is the market cap of all US equities. And I found a source. So for these exercises, it's pretty difficult to, what you want is you want to have all the data of all financial assets across the globe going back to, 1850. But it's very difficult to come by. So you have to look at what are the things we have in the pyramid, in terms of equities and national currencies and gold that we can measure against each other. And this is an interesting chart. It measures the market cap, so the total value of all U.S. equities, divided by the U.S. broad money supply again. So that's M2. And of course, then we see, how much the U.S. equities are worth relative to the money supply. So
let's explain this in intuitive terms. What it's measuring is sort of the middle of the Exter's pyramid. If the value of stocks are growing relative to the money supply, the pyramid is widening, meaning trust is increasing. So people are willing to increase the level of risk by investing in stocks as opposed to holding money.
Exactly.
So trust is growing. And then when the red line is falling, trust is shrinking because people are basically selling stocks to get to cash. They're panicking about the value of money, the value of the stocks. And so they prefer money. Yeah. So it's sort of the next step up in the pyramid.
It's about the leverage between national currency and equity. So, and if the red line goes up, that is more leverage. And if the red line goes down, that's less leverage in the system. But as I've explained in the beginning, the pyramid never shrinks. The pyramid always grows over time. But the gold price rises to counter to make that happen actually. So to counter the pyramid from imploding actually. And that's what you see. You see on several occasions that the leverage between equities and the broad money supply goes down. People run to not only national currency but also to gold, and the gold price goes up, and so the pyramid is reshaped again into a more neutral shape, and there's more trust in the system again.
So your claim here is that as stocks fall in coming years, relative to the amount of money in the system, the gold price will rise. And the reason that relative to the amount of money in the system is important is because, if central banks print ridiculous amounts of money to try and inflate the bubble and keep the pyramid stable, stocks might just flatline or go up a little bit. But the point is that gold will go up more.
Exactly. I'm not saying that stocks will go down, although that can be. I'm saying that gold will go up more than stocks. And stocks will probably go up less than the US broad money supply is expanded. So it's all relative. Also when there's a lot of inflation, stocks can also go up while the economy is in dire straits. The economy needs stable prices, so for it to function. If you don't have stable prices, then the economy deteriorates. But stocks can still go up. Although the price, for example, of gold goes up far more.
It's all relative is the key measure here, especially because the value of currencies is so arbitrary. We've discovered over the last few years. We've been reminded over the last few years that it's pretty difficult to figure out what's going on when everything is moving. You don't have a reference point. I compare it, I think I said this in our last interview, it's a bit like when astronomers realized that the Earth was moving and they sort of had to recalibrate all their calculations for the stars. Well, the value of currency and money is moving, so it makes life a bit difficult. But these ratios do tell you when it's a good idea to be in gold as opposed to stocks, currencies, and so on and so forth. Let's move on to the third chart. We turn a bit more heavily into geopolitics here. This chart is showing the level of gold as part of reserves. So these are reserves held by central banks and governments to back up their currencies nominally or officially or unofficially. The point here is that there's some sort of cycle throughout history and you're expecting things to normalize. So take us through the narrative going back to the 1880s.
Yeah, well, what you see is that the chart starts in 1880, and that was during the classical gold standard. So a lot of people think that every currency was one-on-one backed by physical gold. That was not the case. A lot of countries already had pound sterling as reserves to next to their gold reserves to back up their currency. This became official in 1922 at the Genoa conference, when policymakers around the world decided that foreign exchange backed by gold was allowed to be used by central banks to cover their monetary base to back their currency. On the gold standard, there's an airplane coming by. I live next to an airport, but it's only 2 airplanes a day.
You're in the Caribbean, as you hinted. Your move has been successful. While that plane's coming past, I just want to quickly mention a topic. Hold your thought if you can remember where you were in the story. And you mentioned earlier how difficult this data is to come by, and this chart's a really good example of that. And it's also, I hate to flatter you too much here, it's also the value of your work to people who are interested in the gold market, because the reason I called you an investigative journalist is because you do the digging. You go back and combine these data sources and figure out what they reveal. So that is very much how you've become so prominent to the gold world. So congrats on getting even more data put together to figure out what's going on in this chart.
Yeah, this chart, I think all in all, this has taken me weeks or months to put together, to find the data or papers. A lot of the papers have been digitized. I'm not very often going to libraries anymore, but just to find the papers where some data is in about one country or multiple countries, and then getting everything together and work out how much foreign exchange there was in really it's just. And then I even hired guys in India through Fiverr, this IT platform, and then I hired them to just copy numbers from papers I gave them with data into because I was just too tired of doing it, and that's how I got to make this chart. These are estimates, I have to say, because I've come to understand that there is no global data. You can never cover all countries, etc. But it's pretty accurate. Also, because I compared some data points with other researchers. So this is pretty accurate. Shall I continue where I was from the interbellum?
Yeah, I think you were at just after Genoa, and the fact that the countries were using the pound as part of their foreign currency reserves. So they wouldn't just back their currencies with gold; they'd also use other currencies. That'll change with the world wars.
So in 1922, they decided foreign currencies backed by gold could be used to back their own currencies, and it didn't do a lot, because then World War II came, and the blue line went up again, and it was only after the Second World War that America came out as the great victor, and then Bretton Woods started, and also by how Bretton Woods was designed, more countries started to accumulate dollars, and foreign exchange holdings really took off, and that's what you see from 1950 until the end of the 60s. Actually, at the end of the 60s, America just flushed the world with dollars. This is a bit of a different cycle than we saw in the previous charts. But what happened then is that there was in the 70s a small correction, because the gold price went up so much, but also but foreign exchange reserves didn't really budge that much. It did go back above 60% at the end of the 70s. In 1980, the gold price peaked. And then, of course, because Volcker ended the inflation period in the 1970s, and he took interest rates up to 20% or something. And then the money came back to the dollar again, and the great moderation more or less started. The Cold War was over in, I believe, somewhere in the 80s or maybe 91. And you see the blue line going down all the way to 10%. So most countries were, just accumulating dollars or other currencies. And what that means is that they had a lot of trust in those currencies, and it was also a period of relative peace. There were no world wars. Sorry, and that's how the blue line could reach 10% already at the end of the 1990s, and there was a little blip after the great financial crisis, and the real bottom was actually in 2015 when it was slightly below 10%, and after that it has been rising fast. And especially after what we just talked about, after Russia invaded the Ukraine, and all the central banks, but predominantly the PBOC, just they are buying so much gold that this ratio is going up quickly.
Yeah, so if I were to summarize this, I'd say that the Bretton Woods system sort of unlocked a massive widening of the pyramid, which had some blips like the inflation of the 70s. But the point is that instead of gold being just the only thing at the bottom of the pyramid, it made it seem as though the US dollar could be at the bottom of the pyramid as well. And this unlocked, financial engineering and all sorts of big booms in stock markets, financial markets, derivatives. All of the pyramid was widening. And it's only now that everyone's realizing that the US dollar-based system is a geopolitical risk, that people are thinking, well, hold on a minute, maybe having the US dollar as the bottom of the pyramid is not the greatest idea, actually. And instead of holding each other's currencies, we should be holding the actual asset that is at the bottom of Exter's pyramid, which is gold. So you're anticipating that this realization will continue, that the central banks will continue to accumulate gold disproportionately to other currencies, and that obviously is good for the gold price.
Yep. And not only by what you see the PBOC doing, they're buying a lot of gold, and Saudi Arabia is buying a lot of gold, and also other central banks, Poland, I don't need to name them all, but also you see the world falling apart, and it kind of all fits into this model of the pyramid. And these debt cycles. I mean, just look at what Trump is doing now. He's barking a lot. I know that, but he's making trouble in Europe. He's making trouble in China. He's making trouble with Taiwan. That's just a new world where we're heading to, and that's a multipolar world, and that is a world in which less central banks will hold foreign exchange reserves. They will decline their foreign exchange reserves and increase their gold reserves.
Let's move on to the fourth reason then, the idea that there's this ratio between gold and all financial assets. So you're measuring the very base of the pyramid relative to the size of all of the rest of it, as I understand it. So I can't imagine how you put together the statistics of the value of all financial instruments in the world. It must have been a complex experience. But the basic idea of this chart, again, as a ratio, it shows that when the ratio is rising, the value of gold is rising relative to financial instruments, meaning trust is falling. And when the line's falling, people want financial instruments. They want more risk. They have more trust. They're abandoning boring and safe old gold. So take us through the narrative of this chart.
So indeed, it was quite a hassle to collect the data. Again, a task of several weeks or months, but you like Excel or you don't. One of the primary sources was the IIF, that publishes a lot of global debt statistics, and then through the world of the exchange, the Federation of Global Exchanges or something, whatever, you can get the global stock market cap. That's a starting point. And by the way, in the debt, there is also mortgages, so that's more or less the broad money supply as well. And as a gold measure, I used all above ground gold. Bridgewater Associates also made a similar chart like this, and because I didn't have the resources to go back to 1935, I used their chart as the foundation and tried to mimic their methodology. And when I was able to do that, I could extend the data series. So indeed, what you see is when the blue line drops, there is a lot of confidence in credit again, and the inevitable recessions then come, and the blue line goes up. People rush to gold again. And what you see is in 1942 and 1980, when the gold price was very high, that a lot of people were into gold. There was, very low confidence in credit, and that was actually the start of new debt cycles. So if you believe, we are at the start of a new debt cycle, then be my guest, don't own gold. But I think we are at the end of a debt cycle. So the blue line, the blue bars have to go up, and they also technically broke out, but that's not for this discussion. So I think the bars will go up significantly and reach a level similar to 1980 and 1942, which is, let's say, 8%. The above ground stock of gold, the value thereof versus debt and equities will reach 8%.
If we plug all four of these charts and the assumptions and the expectations in, we get a gold price prediction from you, which is, of course, much too high.
Much too high, yeah. Well, I don't know. I think I did a back of the envelope calculation once, and it gave me $8,000 an ounce, which is very high if you think about it. But I still believe in it, because I just think that just based on the theory, based on the pyramid, based on how debt cycles evolve and how they come and go, and how they reach a top and a bottom, and if you look at the charts, I think it's pretty realistic. So yeah, my let's say medium to long term price target for gold is 8,000. Yeah, I'm long gold, by the way.
Yeah, and the way you put this in the article for Money Metals Exchange, you're right that it would only be natural given the pace at which gold has performed in the past during similar cycles and points in these various charts that we've gone through. So I was only being a bit cheeky by saying it's too high, because the whole point is it's not, once you have this context that we've provided.
And also if you know that if we're at the end of a debt cycle, there's a lot of debt, then and the common way to get out of that debt trap is inflation. Then the other assets will go up a lot as well, just not as much as gold. So, and then gold 8,000 is high, but relative to the others, it's different.
Yeah, I think that's the takeaway I want to leave people with in this video, is the idea that everything's changing out there and everything's relative. Even the value of money has shifted so fast. It's really difficult to try and navigate your way through all of this. And gold is, if it's a part of your portfolio, it gives you that bedrock of having that immutable value that Jan spoke about at the beginning. It's got that no counterparty risk asset side to it, which other financial assets don't. So we might think the gold to 8,000 is some sort of hugely bullish forecast, but the reminder here is that it could just be a whole lot of inflation. Or the other possibility is that financial assets absolutely crash, and so the value of gold relatively again performs well. Everything's moving. You've got the financial markets are a quicksand these days, and gold's the only thing you can stand on. Strangely enough, in that metaphor. Jan, thanks very much for joining us today, and to everyone at home, please do check out Jan's article on Money Metals Exchange. We'll post a link in the description below. Thanks very much for watching.